For the next technical session, I request our chairman, Manjunath M. Hallur, to escort the speaker, T.G Suresh, to the dais and present a floor bouquet. It's my privilege to introduce our eminent speaker and my teacher, C.A. T.G Suresh, also known as Capital Gain Suresh or TGS. C.A. T.G Suresh is a distinguished personal holding CA, CMA and CS qualifications and a commerce graduate from Vivekananda College, Chennai. A practicing chartered accountant since 1988, he founded his firm Suresh and Balaji and a leading expert in domestic and international taxation, representing clients before the AAO, CIT, appeals and ITAT. With 35 years of academic excellence, he is a renowned faculty for taxation, financial management and accounting across ICAI, ICMI, ICSI and motivated thousands of aspirants. He has also trained income tax officials at RTI Chennai and serves as academic counsel of reputed institutions. Recipient of the prestigious National Award from the Capital Foundation Society. He has authored several authoritative books, including Simplified Approach to Direct Tax Laws, Simplified Approach to Taxation, and Capital Gains Tax Law and Practice. He has presented papers at ICAI, NASCOM, and leading chambers of commerce. He has served as chairman of Direct Tax Committee of SICCI and CFO Forum of MMA, and the past chairman of International Fiscal Association, Southern Region Chapter. Besides contributing actively to various ICAI committees and government tax advisory initiatives, he also supports community education through his role in the PS Education Society. He is widely admired for his exceptional program, professional acumen, academic leadership, and enduring contribution to the tax and finance fraternity. With this brief introduction, I present before you the T.G. Suresh sir. Sir, floor is yours.
Good afternoon. I think Manjunath has not served the lunch properly, or he given the lunch heavily. Good afternoon. Thank you. So to the chairman and secretary, both of them are happen students. Actually, day after tomorrow is my brother's daughter's wedding is happening there. The whole family is having some the function. In fact, I skipped the function and come here because for two reasons. One, I cannot say no to Bangalore branch. I cannot say no to my chairman, secretary, or my students. Three, I cannot no to capital gains. So there are three difficulties are there. There is so much of, I don't know whether to call it as hype or whatever it is, about the new Income Tax Act. I think by this time many of you would have seen that. So whether this new Income Tax Act, most people ask the question, so sir, should we have to relearn or is it new? Oh, this is, yeah. So again, only thing is that you have to remember the section numbers differently. Otherwise, seriously, don't worry about it. It's not that you have to completely learn and all. Maybe you have to just do the numbering slightly differently. For example, we used to 45 as a charging section. Now you have to make a small change here, and by this time you can easily guess the 67 will become a charging section. So likewise, you have to reorient, but otherwise I can confidently say that definitely your litigation problem, no issues at all. All the issues, whatever you had in the 1961 Act will continue to remain, no problems at all or no issues. But if you don't have you don't want a problem, there is an issue. Because always we know that the problem of somebody is going to be our opportunity. So in that case, definitely what has been done, maybe you would have heard from two experts in the morning also, that nothing has really changed dramatically. And when I was discussing with many of my friends in the income tax department, they've also told, sir, this is our mandate. Our mandate is not to change the law, it's to just write the law in a more simple language. So therefore, to that extent, if you have come with the thought process that I have to completely learn, somebody asking the question, I'm now 60 plus, 50 plus, 40 plus, should I have to learn? No reason at all. You don't have to learn that way and all, except for some sequencing, some small modifications. And maybe at the end of 3 years, one thing I can ensure that you don't have to really feel that you have to completely relearn to that extent is not there. But having said, I think some efforts were made to simplify the law. But before I start, it's my duty and responsibility to just dedicate this session as well as any of my sessions to my Mata, Pita, Guru and Devam. So this is what I've just set as an agenda for today's session. So we'll have basically first 5-10 minutes just to ensure that we just come from lunch. We'll just try to find out what are the theme, what are the ground rules, what are the drafting approach, what are the core principles, what the government says. It's not my version, it's their version. So what are the changes in the capital gains? So we'll just try have some comparison between the new and existing act, some challenges and the way forward. This is how I've structured the today's session. Now, so what is 45? We'll just try for the first 5 minutes. What is section 45? Charging section? Right. So here the corresponding year is section 67. So what is 46? Now section 46 deals with, in the case of liquidation, what will be how to compute the capital gains. Capital gains in the case of liquidation of a company. Now you can make a guesswork, that will be section 68. 46A. Anyone? Buyback of shares. Now that you can make a guesswork, that will be section 69. Now section 47, transactions which are not regarded as transfer. Now you can make a guesswork, that will be section 70. See, likewise, what they have done is, say, section 47A. Obviously, like section 47A, they want to put it as a separate section number, that becomes section 71. Now, section 48 becomes section 72. Section 49 becomes section 73. So, this is a small kind of adjustment which we have to do. That's all. So, in terms of the remembering the section numbers, the 47A has now become a separate section number. That's all. So, likewise, so 54 series, you have 54, 54B, 54D and all. So each of them have become a separate section numbers. So to that extent, you don't have to seriously worry about in terms of even remembering the section numbers also. So what is the theme with this? Concise, lucid, easy to read and understand. So that is the broad theme of this Income Tax Act. So what are the ground rules which are considered? That's what they say, that eliminate redundant provisions, reducing its length by nearly half. So that is something very interesting. The drafting style of the new bill is straightforward and clear, making the provisions easier to understand. So what we will try this through the exact wording section. I will leave it to your conclusion. I'm not going to make any conclusion on this. We'll just find out whether the new bill is straightforward, clear, and easier to understand. That part of it, we will just leave it to you. So more than 57 tables compared to 18 tables. Subsections and clauses have been used instead of relying on the provisos and explanations for exceptions and covers. So that is something very interesting. They say that subsections, clauses have been used instead of relying on the provisos and explanations. Now this is something, somehow I feel they missed out something here, because the provisos and explanations are there for a very particular purpose. When you try to bring it as a part of a section, sometimes they may not convey the same meaning as they would have done in case it is not their subsection. For example, I'll just give you one practical example, so we had to argue before the trial. So there was a very peculiar case where husband died while he was in job. The wife, a very listed company, came out to the resolution whereby they said the wife will get a monthly pension up to a certain number of years, provided she maintains her marital life. That means she has to continue to remain as a widow. She should not marry somebody. So long as she remains in that status of not marrying somebody, she will get X amount as a monthly pension. Now, the assessee took a stand that this pension was not taxable. So the matter just kept on coming. So before it came to us at the tribunal stage. So during the initial stages, they said that this is a personal receipt, so on, so many things they gave us a reason for not taxing the same. Now, one decision of the Madras High Court, which the assessee strongly laid upon, was any gratuitous payment made to the family member of the employee is not taxable. That was a stand which was taken. The assessing officer passed a beautiful order. This judgment came before the introduction of explanation to section 57 IA. Now what is that section 57 IA says? 57 we all know is a deduction. The explanation to section 57 IA talks about what is the meaning of family pension. Family pension means a regular amount payable on a periodic basis to the family member of the deceased employee. Now this is there in explanation to section 57 IA. Now, what is the assessing officer's stand? The assessing officer says after the introduction of the definition of family pension in explanation to section 57 IA, the assessee's contention that the gratuitous payment paid is not taxable. So I told the honorable judges, now let's see the sequence of the income. That Madras High Court decision was given in the context of section 2 subsection 24 in the definition of income. Now first, you have to decide whether the income, whether the particular receipt is income or not. Then you have to find out whether it comes with the 4 hits of income or not. If it does not come under the 4 hits of income, then it should come under the residual head of income. And once it becomes chargeable tax and income from other sources, then you have to see section 57, right? 57 comes only at the last stage because that explanation is there only under deductions for family pension. It is not there as an explanation to section 224. So immediately the vice president of the income tax appellate tribunal, so let's argue whether it's income or not. Once I'm able to establish it's not an income, then he said, why you are looking at 57 and all? So therefore that explanation to section 57A should be read in the context of 57IA. When that tries to move it as a subsection or not, possibly it would convey a slightly different meaning. So that's what you understand. I'm just trying to give a slightly easier example to appreciate this particular point. So all provisos and explanations about 1,200, 900 have been removed. Can this be claimed as a credit is an important question I want to bring to your attention. So because they have their own purpose. I think definitely this point is to be accepted. The new bill adopts a more simplified reference system allowing provisions cited by simply mentioning the section. In many places they use the word interchangeably, sometimes they use the word clause, sometimes they use the word section. So you can use whichever is comfortable to you. So that is also some kind of confusion in terms of the usage. But I think this we have to give them the credit because of the fact that the references are more logical. For example, take in capital gains chapter itself. 47.6 will deal with capital gains in the case of a merger or amalgamation. Then you will find 47.6b will deal with demerger. Then you will have 47.6d will talk about for shareholders in demerger. Then you will have section 47.7 will talk about shareholders in merger. So 47.6, then you have 6b, then you have 6d, then you have 47.7. So for a company you have to see 47.6. For shareholders you have to take 47.7. For us, if you take the case of a demerger, for the company it's going to be 6b, whereas for shareholders 6d. So in my classes, first I will take all sections relating to merger first and then I will come to demerger. But to remember the sections, even students will find it difficult because this is 6 and 7, that's not a problem. Then you will have 6b and 6d. So what they have done now is corresponded to section 47 in the new Income Tax Act. they're beautifully synchronized. All amalgamation clauses will come together. Then you will have a demerger. So likewise, I think we need to really appreciate the sequencing has been absolutely done very well in many provisions, not only in capital gains. So the previous year assessment year, which is something which most of us are familiar with. So now you have to have only one word, tax year. I think we are all comfortable using previous and assessment year, but they're going to have a one word tax year throughout. So there is no distinction between previous year and assessment year. So they said around 21,000 online suggestions have been received. So analyzed suggestions sought from taxpayers, industry, professional bodies, consultation with the Australian tax office and UK's office tax inflation, and committee of around 150 office and departments actually involved in the entire exercise. I mean, very honestly, after seeing the output of this new Income Tax Act, maybe like this exercise, in my personal view, had they given to the Institute of Chartered Accountants of India and said, this is what the mandate, this could have been achieved at a much lesser time. In fact, we gave Institute Chartered, I also worked with that committee, so gave a lot of representations on the new income tax bill. So many draft pages. I think I must really appreciate the entire direct tax committee which worked day and night to give close to some 500, 600 pages, some wonderful recommendations. I'll tell you, wonderful efforts. It's a great effort by the team. So here, so this much amount of efforts is there, but in terms of the output, there seems to be looking at only one aspect of it, of simplifying the language. That seems to be the more effort than anything else. So 60,000 man-hours were dedicated in finalizing the new bill. I think if I'm in the position, possibly we could have engaged a professional institute and said, got a lot of time. And then on that input, department officials could have also worked on the same. Because day in and day out, so we spend so much of time on this Income Tax Act. I'm sure that we could have done this at a much lesser time. So basically, as we mentioned, so 819 sections brought down to 586. So you'll be wondering how it became 819. Only 298 is what we know. But effectively what they've done is, say, take for example, 47A and all, they've taken it as one section since they've did. So that's why the number, effectively they've taken it as a section and take 298 as 819. Provisos and explanations removed, schedules and tables introduced. Sometimes when you see the schedules and tables, so you always think the act we are given in table, if they themselves are going to give the act in the table, I am wondering, me and other teachers, what we are going to do. That's what next we have to think. So therefore, because that we have already given, so we have to rethink now. So as I said, previous year, tax year, and this is the most beautiful part. Notwithstanding has become irrespective of. This is something I don't know why they like the word notwithstanding. So, but they've changed that irrespective of, and they are also trying to use a bullet structure. One thing which you can observe, if you take section 47, so what is how 47 is numbered? 47I, 47.2, 47.3, likewise the number. But if you go to the corresponding provision in the new act, they use the word A, B, C, D, F up to Z. Now wherever you have, so if you take in 47.13, there will be some conditions there. If that is there as A, B, C, D, they made it as 1, 2, 3, 4, 5. So wherever you have I, double A, triple A, it becomes A, B, C, D. I will show you in many places. It can remain the same, I know. There's no, but I don't find any difference. If you are able to find something at the end of the session, you can please tell me. So once again, though it is a repetition, 47 to 23, 298 to 536, and 5.12 lakh words has become 2.6 lakhs words. But whether the reduction of the words has reduced the litigation or going to do this, that's what we can do see. So last point, because since I've already repeated most of them, just look at the last one, whether these changes can be regarded as substantial changes. You heard from the experts in the morning, so you'll hear my session, then at 5:30 you can conclude. So whether these are going to be called as a substantial is what we have to see. This I will leave considering thing. So the core principles, what they say is that, I think the acronym something they always like GST, good, simple tax. So it is good services tax, but we have to coin an acronym, good and simple tax. I think somehow we always like the term simple. I always used to wonder, whenever I try to use the word simple, at least my experience, I'm sure that you will also agree with you. Once I say I'm going to simplify, then at that point of time only I found that the law becomes more complex. In fact, I remember one chapter when I was a student in operation research or quantitative techniques. There's one chapter called simplex method. I used to wonder why that gentleman kept the name of the chapter simplex. So whenever I used to take that topic when I was teaching at that point of time the quantitative techniques also, all the students asked the question, sir, I can accept anything, but why do you call this chapter simplex? Once you come to income tax, you will know. So there also we're going to call it as simple. Now when the articles comes, you tell him, hey, this work will only take 6 hours. So you would like to have a leave tomorrow. They say, only 6 hours finished up. We all know it is going to take at least 25 hours. See, likewise, sometimes it looks like more an acronym. Don't take it seriously. Streamline structural language, I'll definitely go with that. Yes, fantastic. That is perfect, no doubt about it. Integrated and concise, fantastic. I definitely agree with that. It's well integrated and concise. 3, it is going to minimize litigation. If you're in litigation practice and if you're going to think this M is going to be true, don't worry at all. Actually, they should have changed the word. That M should be maximization of litigation. Wrong term, actually. So then you have practical and transparent. I don't even understand. I think they want to fill up the P and again. So that should be learn and adopt. By whom? I don't know. So still efficient tax reforms. I don't know. Just is all, most of them bearing that first S and I. Rest of them is just I have to fill up. No, I want to coin a word simple, right? That's all. Don't take it seriously. So now we'll move to the topic which was given after the small introduction. I think this is basically to ensure that so you're come back a little bit fresh after lunch. So 67 to 91 is the new income tax sections for capital gains as against section 45 to 55 of the 1961 Act. So I'll just try to name some of the features so that I'll just mentally prepare you for the next couple of hours. Now section 67 corresponding to section 45, subsections, provisos, explanation is removed and they become a separate clauses. Now as a result, you have 67. So earlier, 45, 1, 1A, 2, 3, 4, 5, 5A, that's all. 6 and all was at the 80 CCB. It's all sections belonging to our age group. Now you will be only thinking only up to 5A. Today the charging section of 67 goes up to 6718. 671 to 672C. But if you closely analyze, so if you take the case of 45.1A, so what is 45.1A? Just quick up. Insurance compensation, right? Insurance compensation on account of the section will also talk about floods, blah, 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 natural disaster. What they have done is they've given a separate, I don't know whether to call it as a clause section. I will also be interchangeably using it. When you use the word clause section, it conveys the same meaning only. Don't worry about it. Now, 67.1 corresponds to 45.1, no problem at all. Now, 45.1A has now become 672, 673, 674. Now, if you see how 45.1A become 3, that flood, natural disaster, they put as a separate clause. And then you have subsection 3, it defines who is an insurer. So, therefore, by removing the explanation thing, by putting a separate section, suddenly section 6 now charging section becomes 18. Now we have to strongly motivate our CA students. In charging section, in turn, you have 18 subclasses, if it can be called so. So, but it's the numbers are definitely not an indicator of the length of the section. That's what I just want you to bring it here. So, section 70, which corresponding to section 47 of the present act, I think that's beautifully structured. I think we have to give it to them. Amazing structure. All of them have been grouped beautifully. But in A to Z is the wording used in section 70, as against section 47, which uses the word 47I, double I, and all. And you have, honestly, you have up to Z. So I'm not exaggerating. No, like, in fact, you have ZA, ZB, ZG, and all. I think Gen Z will be screaming at us. So definition, each clause moved to 72. Section 72, which corresponds to section 48. I think that's one area I will just go through. Beautifully explains that indexation is available only for calculation of tax. Because wherever I spoke, many chartered accountants did not agree with me that indexation benefit is not available for transfers made on or after 23rd July 2024. No, it's TGS, I think you are wrong. Indexation options available for individual resident. I said no. It is available only for collection of tax, with amendment is made only in section 112 1A proviso. It is not there in section. You go to 48 second proviso, you will find before 23rd July 2024. But if you look at the Income Tax Act 2025, this will be absolutely clear to anybody that indexation benefit is not available at all. I think that where the language is so simple and so easy, not like the existing wordings. Now, if you take section 48, non-allowability of interest and STT, they have tried to group into a separate section. If you have been familiar with section 48, the interest on capital borrowed is not allowed as deduction. It will be there in section 48 proviso, and whereas STT not allowed to be there in a different section. So what they've done is they just brought it into a single section. So that's what the synchronization is beautiful. As we go along, we'll just try to find out that. Now, as far as section 73 is concerned, they talk about table. Where is there a table in capital gains? Now, you read section 49, right? Section 49 leaves the circumstances in which cause in a different modes of acquisition. For example, if I get the asset from my father by way of inheritance, section 49.1 talks about it will take risk cost to the previous owner. Like with a lot of circumstances mentioned in 49.1. So 49.2 in the case of shareholder receiving shares in the case of merger. So like 49.3, what will happen in the case of when the gift is attracted. So likewise, you have 49 at various subsections are there. So what they have done corresponding to section 49 in section 73, they just put that in a tabular form. The entire 49 appears in a tabular form. Suddenly I started thinking that, oh, so suddenly is there, my book is there in Income Tax Act, because just try to simplify, just put a table. So in these circumstances will be the cost. So, but it looks very interesting. It not look like a law, but the presentation will be a lot more simpler for many people. Now section 77, which corresponding to slum sale in section 50B, this is pretty surprising because just now the government decided to reduce the holding period of the capital assets. But in the case of a slum sale, even today, even with the new Income Tax Act, only after 36 months it is considered as a long-term capital gains. When we just try to synchronize and analyze, maybe I heard from one of my friends in the Income Tax Department that in this February 1st budget, there will be a lot of amendments will be made in the new Income Tax Act 2025. A lot of amendments they have planned. So therefore, maybe 50B will see some changes there. I will just have only one slide just to that, because you can leisurely go through this. 45.1 is 671, whereas section 45.1A has become 672 and 673. As I mentioned, the natural calamities are put into a separate section. The explanation to 45.1A has become section 67.4. Now, this is how what they have tried to increase the number of sections by say. So don't worry about it. It's not a change. By removing the explanation and the proviso, putting to a separate section, number of clauses section looks more. That's all. So I just try to give you the comparative sections everywhere, but we'll just try to skip that. I'll maybe towards the end we'll try how to remove the sections. So look at the charging section alone. I'll take in stages. So first, just to show that the objective initially is to show that there is no dramatic change. That's the whole idea. Then we'll subsequently try to find out how we can interpret and how the controversies could still continue. Now, any profits or gain arising from transfer of capital asset effect in the previous year shall save as otherwise provided in sections 54B, D, E, EA, AB, SC be chargeable to income tax. Now, the only change what I have to do is, instead of 54, 54B, 54D, EEA, I have to move to the corresponding section. Right? That's all I should do. Have they done that? Any profits or gains arising on transfer of capital effect in the tax year. So here is the previous year. Since the concept of previous year has changed, I've changed it to tax year. So therefore, the basic idea is that don't think that a dramatic change has taken place and all. I changed the word previous year. There is no concept of previous. That has become tax year. That's what I made there, tax year. Shall save as otherwise provided in 82, 83, 84, 86, 87, 88, and 89. So now if you just come here, 54, the corresponding section is 82. 54B, the corresponding section is 83. 54D, the corresponding section is 84. Now you don't have 54EA or EB. Those sections are removed. So consequently, I'm also trying to remove that. So what they have tried to do is one noticeable change. So in 45.1, as on this date, 54EC is not there at all. As on this date. So what they have done is, in the new section 6.7, they brought corresponding section of 54EC. So they noticed this is not there, so they brought it. So otherwise, you can just find absolutely there is no change except for the word previous year, I made as a tax year. And whatever exemptions which are not relevant today, which has been deleted or not in use, that I have removed. Absolutely no change at all, except you have to only remember the section number. So one very noticeable point, as I mentioned to you, so now just go to the other section which I've talked about, 45.1a. So notwithstanding anything in subsection 1, by this time you can make a guesswork. Notwithstanding has become what? Irrespective. So therefore, irrespective of anything contained in subsection 1. So where any person receives at any time during any previous year, any money or other assets from an insurer on account of damage to or destruction of any capital as a result of blah blah flood, typhoon. So you go see there as a result of the circumstances mentioned in subsection 3. So what they have done is, so here on account of flood, typhoon, hurricane, cyclone, earthquake or other convulsions of nature, riot or civil accidental fire, blah blah blah. So that is, it is there in section 673. See that portion of the section, I removed it, cut, put it as a separate section requiring 60,000 hours. Yeah, I'm only saying the lighter side of it. No, they took 60,000 hours for convert to a separate section. Now, at least I would have been happy, because when this section was introduced, in 45.1 it was introduced, there was no, at least I'm coming from Chennai, at least I would have liked that to be there in the new section. Because we have seen tsunami. In fact, our class is the only class which is held on the tsunami. All the parents shouting, no, why you are having class? Especially students from outstation students, they were worried about. I said, first tsunami will only me. So you don't worry about it because, yes, there, but we are only concerned about the safety. Don't worry about it. We can continue. There's no problem. It's happening somewhere at least 2 kilometers away from our place. So now, even in the new section, in section 67(3), you don't find tsunami. When the section was introduced, understandable, right? So when the section was introduced, tsunami was not there in India. But having seen tsunami in India, at least you could have included that effort we could have taken, having spent 60,000 hours. Now, that goes to a separate section. But what possibly, ideally, now like you can see, for the purpose of section 72, here you will find for the purpose of section 48. Now, why this 45(1)(a) came? Is a question. Now, 45(1)(a) was a very interesting section which has to be introduced to nullify the decision of Supreme Court in a very, very popular case called Vanya Silk Mills Private Limited. Now, there an asset was destroyed by fire. Insurance compensation was received. Now, the issue here is that the insurance compensation receipt can be brought to tax under capital gains. This was a simple issue there. Why the compensation was paid? The compensation was paid because the asset was destroyed. You get the compensation. So what the income tax department took a stand, the insurance compensation was taxed as a capital gains. For the sake of simplicity, we'll take the cost of acquisition 0. So the entire insurance compensation was taxed as a capital gains. Now, in order to come under capital gains, what are the conditions which we need to satisfy? There must be a transfer. There must be a capital asset. There must be a profit or gain. So these are the 3 conditions you have to satisfy, right? Transfer, capital asset, profit or gain. Now, what is transferred here? There must be a transfer of capital asset. What is transferred in this particular case? There was an asset. That asset was destroyed by fire. Who paid the assessee is the person who is supposed to transfer the asset. But who is the other person transferring? Insurance company. So they gave insurance compensation. What did the insurance company get in turn? Salvage. Nothing, right? At the end of the day, the department took one of the stands. But once the insurance claim is settled, all of us as a commerce student have read principle of subrogation. The insured steps into the shoes, even if he's wearing a chapel, he will step into the shoe. Now, all rights in the asset goes to the insurance company. So the counsel for the assessee argues, so now what did he transfer? Why the amount was paid? Asset was paid was because the entire asset was destroyed by fire. Can I transfer something which I don't have? Now the entire asset was destroyed. So can I make a payment for something which I don't have was the question. So the Supreme Court made a beautiful observation that transfer appearing in section 45 requires a transfer of a capital asset by one person to another. So under that, right with section 247 is there, you cannot trigger the charging section. So that means there is no capital gains arises on account of insurance compensation. Judgment given in 1991, this section came in 2001. Today, we can challenge or amend on account of tribunal judgments that this was a Supreme Court judgment which took 10 years for them to amend the law. No capital gains on insurance compensation. Why? There is no transfer of a capital asset. Now, read this 45(1)(a). Notwithstanding anything contained in subsection 1 where any person receives at any time during any previous year any money or assets, insurance on account of blah blah blah, such money, value of any asset as on shall be deemed to be the full value of consideration received or accruing as a result of, see the last line, transfer of such capital asset. Tell me one thing, does 45(1)(a) require transfer or not? Does it require transfer or not? See the last line. Just go to the Supreme Court decision. Supreme Court decision did not say there is a transfer. Right? See the last line, it says accruing as a result of transfer of such capital asset. Does 45 requires transfer or not? Yes, no. If you say yes, then go to Supreme Court decision. The Supreme Court decision says the transaction not a transfer. Then 45 becomes redundant, right? So here, if you take that stand, it requires a transfer, then you have a problem. That's the Supreme Court decision. That means you cannot accept. So what I'm saying is that, right, you have not addressed that particular problem in 45(1)(a). When you try to write a new income tax act, should you not avoid or not? Right? You should mitigate litigation, no? So there possibly in this particular case, your simply language can also come back and say for removal of dust. They will not use that, but they can say that the new section 672 does not require any transfer. Something can be there, no, because it's a well-established decision, that's the result. So at least when so many times when number of hours were spent with so many, a lot of online suggestions are made, what we could have done is certain controversies in the simple language you could have stopped. That is the only point which unfortunately, look at the cosmetic change here, notwithstanding has become respective. Subsection 1 remains a subsection 1. So here if you go to 72 is the new corresponding section of section 48. And that flood, typhoon, hurricane moved into a separate section. So therefore, after doing this change, and if you still feel there will be a litigation coming down, I am not sure to what extent litigation is going to come down on account of that. Now look, look at this, the section which is the hottest section of the controversy per se, 45(5)(a). Now, notwithstanding anything in subsection 1 where the capital gains arise from necessity being an individual or HUF from the transfer of capital asset. Just read corresponding particular points. You will not find, barring the section 48 becoming 72, nothing will be there. Now today tell me, when does the capital gains arises in the case of JDA? On the date of entering of JDA? On the date of you receiving the property? When does the capital gains on JDA arises? Especially after the decision of the Supreme Court. Taking into account Balbir Singh Maini, so where after the amendment of section 48, so many cases are there. Can we decisively conclude whether the capital gains arises on the date of entering into JDA or on the date of receipt or registration of the property? Which is the date of the capital gains? I will give you 150 decisions which is not date of JDA. No, we'll get into that separately. We'll have a topic on that. What I'm saying is that, so here, there are many tribunal decisions which are going against each other. Now, again, the fundamental point is that this particular section is given only for 45. In fact, this particular section was based on the recommendations of the R.V. Ishwar committee. In fact, incidentally, on that particular day, sorry, was there was a political party procession was going on, and therefore many members of this particular presentation, when he concluded, could not come. Fortunately, I went there early. He was also there early, so I could get an opportunity to interact with him for half an hour, 45 minutes. So when this particular point, all the members who are there, when we just try to talk about the possible issues relating to 45, the JD at that point of 247.5. So R.V. Ishwar understood what you said, and this is one of his recommendations where, so we talked about two important problems in JDA. One, when you say the date of entering JDA, as my friend says, the problem here is that then what will be the computation of capital gains? What should be taken as a consideration, right? That becomes a problem. You want to take the capital gains on the date of JDA, right? What will be the consideration? So you say transfer is complete, but profits or gains is required. But what is the consideration? How to arrive at the consideration? Now the consideration, how do I take? At that point of time, one stand which most of us will be taking, we continue to take whenever 45 is not applicable. The cost of construction of flats allotted to me is even today considered as a consideration. But whether it is known at the time of date of entering into JDA. So therefore, what will happen if eventually the property is not given? So that is one reason why in 45(5)(a) he brought two things. So one is the capital gains will arise only when you get the assets or get the house in your name or allotted to you. And two, the guideline value or the stamp value is considered as the capital gains. But again, if you look at this, is available only for individual HUF. I don't know about Karnataka. In Tamil Nadu, nobody registers the joint development agreement. And they will come back and tell you, no, registrar does not register JDA, which is not the case. The stamp duty on that is very high. And if you do it, the project might become unviable. But what they generally say that JDA is registration not permitted in Tamil Nadu. They are rewriting their own law. So we can accept the fact that pushes the cost of the project, fantastic, acceptable. But don't say they're not registering. So virtually what happens, 45(5)(a), we all know this is applicable only for a registered. So what if it becomes unregistered? What is the effect of this in the bulk basic mining? Have you addressed in News 6 and 6714? The answer is absolutely no. In my view, they could have taken the simple step of clarifying and said, still people may litigate, that's fine, but most of us would not like litigation, right? So therefore, you could have said, extending this to all assessees, and then you could have also clearly defined those issues they face, whether registered. Now, why you wanted to make it registered? Because at the end of the day, your objective here is to simplify the law. You can relax a bit and could have taken some extra steps. That's my only point here. So here, they could have understood what are the difficulties posed to 2017 decision of the Supreme Court and made a change accordingly. Right. Now let's take a very interesting one. When you just try to cut your explanation of provisos in the main section, it results in some very, very surprising, shocking interpretation. Take your time. This is section 47(4). Similar things also applicable for 47(5). Now read this 47(4). Any transfer of a capital asset by a company to a subsidiary company. This is the existing 1961 Act. I think unfair to call it as an old act. Maybe it's better to call it as the existing act. So any transfer of a capital asset by a company to subsidiary, if the parent company or its nominees hold the whole of the share capital of subsidiary company, and the subsidiary company is Indian company. Now look at the proviso. Provided nothing contained in clause 4 or clause 5 shall apply to the transfer of capital asset made after 29th day of February 1988 as stock in trade. Now, I'll just try to explain what they're trying here. Now, what basically 47(4) says, if a capital asset is transferred by a holding company's subsidiary, the transaction is not legal as a transfer. Right? The only condition required for this purpose, the entire share capital must be held by the holding company, 100% shareholding. Now, what is the underlying logic here? Only chartered accountants can understand this. Because here the sale is happening between holding and subsidiary. So, holding company makes a sale to subsidiary company. Now, the entire subsidiary company shareholding is held by whom? The holding company. Therefore, any profit made in this transaction, though in the eyes of law, holding and subsidiary are two separate entities, the profit is only within the group. So therefore, what 47(4) says, if you satisfy this condition, you don't have to pay capital gains tax. However, logically for the subsidiary company, you will not get the actual cost as a cost. The cost will be taken in section 49(1) as a cost of the previous owner. So basically the objective is tax neutral, or you have to pay tax when the profit is made outside the group. Especially same basis on which what we do in accounting. Now the last line, the proviso, provided nothing contained in clause 4 shall apply to the transfer of a capital asset made after 29th day of February 1988 as a stock in trade. Now what is that they are trying to say here? That's what the very interesting change. It's actually a beautiful proviso. Now let's assume in the holding company I have a land, which is my capital asset. Subsidiary company is into real estate business. Now, if the subsidiary company also takes this as a capital asset, there is no problem at all, because holding company does not pay any capital gains tax, but when the subsidiary company sells the capital asset, it will pay the tax based on the cost of the holding company. That means whatever tax which is exempted under 47(4) will be captured in the hands of the subsidiary. But a lot of people used to plan in such a manner where if the subsidiary company's object clause is to buying and selling in land, so what is capital asset to the holding company will go to the subsidiary company as a stock in trade. Now, when the subsidiary company sells the stock in trade, under which head of income the income becomes taxable? Business income. You don't have a provision similar to that of 49(1) in business income. The concept of cost of the previous one is not there in business income. So what will happen? Holding company will take the capital gains benefit, but subsidiary company will pay tax only on the basis of actual business income. That means there is a loophole in the law, which they try to address it by saying that if the transfer is made, if in the hands of the transferring company it becomes a stock in trade, then you cannot avail the benefit. That means 47(4) will tax the capital gains. This is what the idea about it. Now, what is their initial intention? All provisos and explanation has to be removed, right? So what I'm trying to do is, this proviso, I'm just trying to bring it as a part of the section itself. So here, transfer of a capital asset. Just clearly listen what this proviso is trying to say. Shall apply transfer of capitals made after 29th day of February as a stock in trade to the transferee. That is what the proviso says. So what they have done, they removed the proviso, and in the main section, look at what 71C says. Transfer of a capital asset not being a stock in trade. That was not the law at all. I mean, that is what this section was trying to convey. So I just removed the proviso, put it as transfer of a capital asset not being a stock. Stock in trade is never a capital asset, right? So stock in trade can never be a capital asset. See, therefore, I just want to remove the proviso, put it in the main section, look at the meaning it conveys. In fact, it does not convey any meaning. And all of you, if you are trying to, unless they change the law, if you want to use the tax planning for holding to subsidy transfer, wait for this new income tax act to come. Right? So that means whatever effort they have taken to plug the loophole, in the name of simplification I'm giving you. But take it in both the hands. Now why you complain when you get in the benefit? So therefore they say transfer of a capital asset not being a stock in trade. Stock in trade is never a capital asset, right? No, sometimes you read that you will be shocked. I was just trying to read 150 times to understand what they are trying to say. Transfer of a capital asset not being a stock in trade. No, stock in trade is not a capital asset. How that can possible? This proviso, when you just try to insert into the main section, this is the problem. So you can remain with the proviso, no. I mean, you can reduce the proviso, but there's no need to remove the proviso and explanations. Just for the sake of simplicity, I'll just touch only the new. This is one very good change they made. Now 72(2), which is basically 72 is the corresponding section 48. If you're familiar with 48, we'll just try to, that's why in just side by side I'll just try to put it as. Now, since we want to eliminate the proviso, the second proviso to section 48 provides for indexation, right? Second provides section 48 provides index. We don't want proviso. That means where it should be there. It should be there as a subsection or clause, whatever you want to call. So the second proviso has now become 72.2. I think that's where they've done a fantastic job. Now, they don't say how to compute capital gains, they're in 72. Full value of consideration minus expenses minus cost of acquisition minus cost of improvement. Simple. New 72 is very clear. And then they say 72.2, for the purposes of item B of the formula in section 197.3, the provisions of subsection 1 shall have the effect as if for the words cost of acquisition, cost of improvement, the words indexed cost of acquisition and indexed of cost of improvement have been substituted. I think just look at the beautiful wordings there. Now what they are making absolutely very clear. Now what is 197.3? By this time you can easily guess that 197B3 is similar to 112.1 proviso. That is what has become 197.3. So 112 deals with tax rate on long-term capital gains. 112.1A deals with for individual and HUF. So that they brought it under 72.2. That is, the indexation will be available only for the restrictive purposes of calculating the tax payable under 197B3. So now let's go to that section. So in the case of individual or HUF being a resident, in the case of transfer of a long-term capital asset being a land or building or both, which was acquired before 23rd July 2024, the excess income tax computed as per the following formula shall be ignored. So therefore, in the new Income Tax Act, they are making it very clear that indexation is available for individual HUF only for rate purposes. But there is a small catch here. It's a very interesting point. Now, just go to the existing if you want that. They also just makes it very clear. Before 23rd July 2024, you can get the indexation. Now, I put the corresponding 112.1 second proviso. Now, just read that 112.1 second proviso only. Provided further, in the case of a transfer of a long-term capital, being a land or building or both, which is acquired before 23rd July 2024, where the income tax computed item B exceeds the income tax computed according to the provisions of Act as they stood immediately before the amendment by the Finance Act number 2024, such excess shall be ignored. That they are just trying to put it in a simpler language with a formula. E means excess tax to be ignored. A, the tax calculated 12.5%. B, tax calculated 20% after indexation. So the same provision, if they rewritten well, the answer is yes. To that extent, the answer is yes. But now comes a very interesting point. Now, if you go to 112.1 second proviso, provided further in the case of transfer of long-term capital being a land or building which is acquired before 23rd July 2024, is the assessee there or not? 23rd July 2024, after that you find in 112.1 proviso, before 23rd July 2024, by the assessee, is it there or not? It is, nothing is mine. It's only completely copy-paste from the Income Tax Act only. Is it there or not? In 112.1 proviso. Is there assessee there or not? Yes, no? No. Now let's take a very simple example. So I just, with the permission of my mother, she died in September 10th, 2024. So knowing these changes, she's actually, we used to talk between 4 a.m. and 5 in the morning every day. Now she decided, okay, I should not give any trouble to my son, who's supposed to be a tax expert, that too in capital gains. That is why she did not leave any land or building at all. But assuming for a moment, so she purchased a land. I'm not the only son, but we'll take for example, I'm the only son. I inherit that land, right? She died on 10 September 2024. Definitely I could not have acquired the asset before 10 September 2024, right? Before 23rd, not possible. Just read that section. provided further in the case of a transfer of long-term capital being a land or building or road which is acquired before 23rd July 2024. Now tell me, if I want to sell the asset today, if that land, is it short-term or long-term? Long-term. Will I get that option of 12.5% without indexation, 20% after indexation? Will I get the choice or not? Why? So here, one reason possibly I'm presuming on behalf of those who said is, so here which is acquired before 23rd July 2024, but my friends in the income tax department could say, T.G. Suresh, when did you got the asset? Your mother died on 10 September 2024. You are the person who's selling the asset. You would not have got the asset before 23rd July 2024. You got the asset only on 10 September 2024 or thereafter. Therefore, they could still say that, look, this section may not even apply to you at all. That means you will not get the concession. But at least I can go and tell him, in case of inheritance, cost will be determined under the cost of the previous owner. The moment I take the cost as cost of the previous owner, holding period of the previous owner will also be considered. Now, in those circumstances, FMA on 1/4/2001 is also allowed. So, therefore, on a harmonious reading, plus one very, very important point, which is acquired before 23rd July 2024. In 49(1) cases, I can tell my friends in the department, look, here the cost is taken as cost of a mother. The section does not use the word which is acquired before 23rd July 2024 by the assessee. It's actually missing there, right, in 112(1) proviso. Therefore, at least I can convince my friends in the department, since the word assessing officer is, assessee is missing there, on a harmonious reading, you should give him that benefit. At least that possibility does exist. But now, go to the Income Tax Act 2025. So now in Income Tax Act 2025, so they are trying to define what is the indexed cost of acquisition. Now, the indexed cost of 72(2)(b), definition of indexed cost of acquisition. The indexed cost of acquisition means an amount which bears to the cost of acquisition the same proportion as the cost inflation index for the year in which his asset is transferred bears to the cost inflation index for the first year in which asset was held by the assessee, or for the year beginning on 1/4/2001, whichever is later. So here, the indexed cost of acquisition, which bears to the cost inflation index for the first year in which the asset was held by the assessee. So now, so here for the purpose of rates of tax, in this particular case, the controversy continues to remain here, because they have linked 197(b)(3) and they are saying that, so then the assessing officer could ask the question, I will give you that benefit, but what is the indexed cost of acquisition here, in this particular case? You got the asset in 24-25. Assuming I sold in the last year itself. The department could still take a stand under the New Income Tax Act also. The numerator, denominator, I'll give you 20% of indexation, will give you. That's not a problem. But in this particular case, numerator, denominator, if you sell in the same year, could be same. Now, is it not possible for this new income tax legislation to address this issue is the question. Now, we just read that SIM, mitigation of litigation. Now, almost we are, so 1 hour into a session. Now, is it that M is minimizing or maximizing? It's okay. So, therefore, what has not been done here, they could have simply said here, in the cases covered by the corresponding provisions of section 49(1), which corresponding to 49(1) here is the section 70. So, by the assessee, or whenever the cost determined of 49(1), the previous owner, had they made this very small change, definitely the M would have lived up to the reputation of many biasing the litigation. You don't have to do much. I'm not saying you test the controversial points. It's a very simple point, right? When you take the cost as cost of the previous order, the holding period of the previous order, the indexation should also go back to that year, right? It's not a controversy at all. When your objective is to mitigate the litigation, want to simplify the law, why they choose not to do it on an area? There is a Madras High quotation is there is a Bombay quotation is there, and I don't think this definitely the department should disagree with those decisions, because the whole concept of inflation, just visualize for a moment. My mother got the property on 1/4/2001. After 25 years, you cannot say it does not get any inflation at all. Let's assume she bought for 5 lakhs. If it is going to be 363 by 363 after 24 years, visualize, after 24 years the cost remains the same. So therefore, that is in principle wrong, but the department fought for it, lost the cases, fine, you allow under the existing act, law take its own course, you continue to litigate, let the Supreme Court decide, fine. But what about the new income tax act? The new income tax act, you could have made this very, very simple change, SSC or the previous one, as the case may be. So, which at least in the existing 112 proviso, it looks contention a little bit more easier than the new income tax act. So that's where I think they seem to have slightly missed the trick here. Now, this is section 15. So what is one very important controversy in section 50? Now, so here the last line, such excess shall be deemed to be the capital gains arising from the transfer of short-term capital assets. That's a crucial controversy there. In case if a depreciable asset is sold, even if the capital asset is a long-term, that will be considered only as short-term. For what? I'll just leave the beginning of the section. The provisions of section 48 and 49 shall be subject to the following modifications. Read with the first line. Notwithstanding anything contained in 242A. 242A is the definition of short-term capital asset. Starting line, it overrides the provisions of 242A. Then you go to the last line, the provisions of 48, which is a cost of acquisition, shall be modified. What is that they are trying to say? You purchase an asset for 100 lakhs, your claimed depreciation of 60 lakhs, the WDP is 40 lakhs. When you sell this asset, if I allow you a cost of 100, since you have already claimed 60 as depreciation, and if you are allowed a cost of 100 in capital gains, that means you are getting benefit under 2 heads of income, which has to be prohibited, which is done by section 50. There is no doubt about it. But what it says is that the capital gains should be considered as a short term, irrespective of the holding period. Now let's assume I have only one building. I don't have any other asset. I sell it after 2 years. Is the capital gain short term? Yes, right? Will I get 54 easy or 54 F if I'm an individual? Will I get 54 easy? 54 easy is available only for long term. 54 F is also available only for long term. But if I have a depreciable asset which is sold after 24 months, which is computed as short term capital gains, will I get exemption into 54 F or 54 EC as the case may be? I'm not going for 54 because 54 is available only for residential house. Yes or no? So short term capital gains, will I get 54 F, 54 EC? Just make a short term capital gains as per 50. Yes, no? So the matter has already been settled by the Supreme Court. That the provisions of section 50 is only for the purpose of computation of capital gains, but for the purpose of 54 EC or 54 F, it will be only considered as a long-term capital gains. The matter is well settled. The decision is Supreme, they have not applied for review petition, so they have not changed the law. No amendment made in section 50. Against the Supreme Court decision also, they have not filed a review petition. What does it mean? Department in principle has accepted the fact that for the purpose of section 50, the capital gains is short term only for computation purposes. Otherwise, you should have amended the law or you should have filed a review petition. Both you have not done. That means what is your stand? You yourself accept the Supreme Court decision which says this will be considered as a long-term capital gains for the purpose of 54EC or 54F. Stated position. It's a Supreme Court decision, no review, no amendment, right? That's what you will conclude. The decision is not now, long back, more than 10 years. Now, you move to the, okay, fine. For some reason, you have not done section 50. When you write a new Income Tax Act, you have only two choices. Now, why the Supreme Court took that stand? Let's take that stand. Now, opening line, notwithstanding anything contained in 242A. That means it overrides which section? 242A. Then go to the fifth line. The provisions of 48 and 49 shall be modified. Provisions of 48 and 49. What is 48? It says, when I buy a building for 100, what is my cost? 100, right? But if I claim depreciation of 60, the WD is 40. So what section 50 says? We already allowed you depreciation, we already deduction to business income. Therefore, for capital gains purposes, you should take only 40 as a cost. That's what it says. But the last line, what it tries to add, it says the capital gains shall be always considered as short term. But what the Supreme Court says, to take this as a short term for the purpose of 54F or 54EC, the wordings should have been notwithstanding anything contained anywhere in the law. Yeah, like what you have in 43B. They should have used the word notwithstanding anything contained in Income Tax Act. You said notwithstanding one in 242A, and you also say only for the purpose of section 48. Therefore, for 54F or for 54EC, this capital gain should be considered only as long term. What are the two choices you have? One, you don't accept this view of the Supreme Court. Then what you should have done? In the new Income Tax Act, notwithstanding, by this time you would have made a guesswork. Notwithstanding will become irrespective. Irrespective of anything contained. There 242A, the definition of short-term capital asset and the new Income Tax Act comes under 2101. So, section 2101 for a capital asset forming part of block of assets. The provisions of 72 and 73. 72 is similar to 48, 73 is similar to 49. During the tax year, instead of previous year, I use the word tax year. The full value of consideration received or accruing transfer of one or more block house is the total of the following. Expenditure incurred wholly in excluding connection with transfer. The WDV of the block of assets at the start of the year. In that provision we will find at the beginning. So I think they went to, you see, like Google Assistant, ChatGPT, what is the alternative word for the word beginning? Please list that. They found start. So when you put a start there, it can remain as beginning itself. What difference it makes? So therefore they put a start. That's all. Such excess shall be deemed to be the capital gains arising from transfer of short-term capital assets. So therefore you have two choices according to me. Either you come back and clarify this is only for the purposes of computation of capital gains. For exemption you can take this as long-term, option 1, or put it. What is the Supreme Court said? Your language does not cover 54EC or F. You cover there. You come back and say, irrespective of anything contained anywhere in the Income Tax Act. Over, no, you have settled one controversy. Certainty is there. Either you die or you become fit. You can always not be there in ventilator. No. Two choices, either kill or recover them. So we continue to do this. That's why I said, if you feel that new Income Tax Act simplified, the answer may be yes. But does it mitigate the litigation? None of the litigations, even settled issue, they are not taking any position either this way or that way. I think you should have taken a position. That's what I'm saying. You take a position that is not the intention of the law. I still remember when I said the short-term capital gains was eligible for exemption under 54EC, depreciable assets, in my third or fourth speech in the 1990s, the chief guest at that particular program, the Chief Commissioner of Income Tax of Chennai, he pulled the mic from me and said, if you want to appreciate for this discussion, you do it. Department will never accept this concept. Don't even try. In fact, after the Supreme Court decision came, I sent a message to him. Sir, you disagreed and department not agree, but unfortunately, the Supreme Court did not agree with that view.
No. So, in fact, I had a sweet revenge time for him sending a message back to him because we are good friends even today. But I'm saying that when he was just trying to do. So now, look at the next line. It will be, I hope that is there in the slide. Now, if you look at this section, have you find, so this is something I used to really laugh. Just 1 second. I understand this. T10, right. Right. Now, did you see the previous section? What instead of beginning, what they used? Start. At least they should be consistently move. Now, you see the very next section. The cost of writing the block of national liability with the block of the beginning of the tax year. Now, in subsection 2, they use the word start instead of beginning. Look at subsection 3, we are back to beginning. Start or beginning. My friend says, Atish, there should be name for the tea. Right, so we'll take a small break. I hope that I'm reaching you, but the tea break will decide. Thank you very much. We'll take a small break and come back.
So just trying to give a bit of a comparative provisions between the old and the new. Now, so we'll just exclusively deal only with the New Income Tax Act alone, because I just want to compare. There's not much of a difference except for the sequencing the section numbers. But however, like the corresponding section of section 50C, one of the most popular sections which we deal with, section 78 is correspond to section 50C. So definitely they made a simplification section. It looks a lot more easier to read. Now, if the consideration received or occurring from the transfer of a capital asset, being land or building or both, is less than the stamp duty value, then for the purpose of 72. 72 is similar to section 48. The stamp duty value shall be deemed to be the full value of consideration received or accruing as a result of such transfer. It's very simple, not an issue at all. However, if the stamp duty value does not exceed 110% of the consideration received or accruing from such transfer, such consideration shall be deemed to be the full value of consideration. Now, this drafting error was there in the 50C also. Now, it looks really surprising, which they could not work on this particular point. Now, so what is it they're saying in the next point? Without mentioning it as a proviso, however, if the stamp duty value does not exceed 110%, just looks like you reading a notes. That's what they've done. The law has become more a notes type one. If the stamp duty value does not exceed 110% of the consideration received or accrued from such transfer, such consideration. What is that such consideration? They're mentioning there. What is that such consideration? That's the actual consideration, right? Now see the language there. Such consideration shall be deemed to be the full value consideration. See, I can say a fiction of stamp duty is deemed. Can you say what I received actually is deemed? So, okay, in 50C you made a mistake. At least if you come, what ideally they could have said, if it's 110%, then the provisions of 78(1) not applicable could have been a simple language, right? What essentially you say, if that 100, basically this is safe harbor. So up to 110% it can do. What I could simply say that main section is not applicable. That means the main section is not applicable. What will happen? Your actual consideration is going to break. You can't come back and say the actual consideration, the deemed consideration. Now comes the next point. Without prejudice to the provisions of subsection 1, the assessing officer may refer to the evaluation officer, the capital asset where the assessee claims that the stamp duty value exceeds the fair market value of the property as on the date of transfer. The stamp duty value has not been disputed. Now this is one area. What is the wording used there? The assessing officer may. Is this provision discretionary? You dispute, the assessee claims that the stamp duty value exceeds the fair market value as on the date of transfer. That's what I claim. Should the assessing officer refer to the valuation officer, or does he get an option? Consistently, the courts have held the word may appearing in this section does not give you discretionary power. You have to refer. It's consistently there. You also accepted that position. So therefore, either you could have used the word shall here, or you can say the assessing officer must, should, whatever. If you don't like the word shall, you use the word must. Start beginning. Now comes the third point, which is a third clause or section, whatever you want to name. If the value determined by the valuation officer on a reference made under subsection 2 exceeds the stamp duty value, such stamp duty value shall be taken as a full value of consideration. Now, what is it they are trying to say here in subsection 3? Now here you make a reference to the valuation officer. The department valuation officer comes out with a value. Now, what this section says, the value determined the valuation officer on a reference made in subsection 2 exceeds the stamp duty value, such stamp duty value shall be taken as a full value of consideration. So, I'll tell you the idea here. Let's assume the stamp duty value is 150. You make a reference to the valuation officer. He says the value is 170. So assessee claims the market value is less than 150. So therefore he says go and refer to the valuation officer. Officer refers to the valuation officer. He says the value is 170. So therefore they don't want a situation where to substitute 170. In that particular case, it should remain as 150. But if it determines the value as 120, then you should take 120. So that means the valuation officer value can only act as a reduction, but the maximum can be only stamp duty value. But what is that subsection 3 saying? If the value determined the valuation officer on a reference to value under subsection 2 exceeds stamp duty value, such stamp duty value shall be taken as a full value of consideration. Go to the beginning. If your actual consideration has to be compared with what? Stamp duty value. So take whichever is higher. Now subsection 3, in the existing 50C, the wordings are completely different. When you just try to put it as each subsection, now suddenly it just gives a different meaning. If you satisfy subsection 2, the value determined on a reference made under subsection 2 exists a stamp duty value, such stamp duty value shall be taken as a full value of consideration. I'll show you some example here. Let's take the first situation. 100 is the actual consideration, stamp duty value 120, value by the department valuation officer 125. What will be the full value of consideration? No problems here because value of the valuation also 125. Then the consideration becomes 120 by applying which section? Doesn't matter whether it is 78.1 or 78.3, right? No problem. In both the cases, the amount answer will be only 120. No problem at all. Whether I apply 78.1 or whether I apply 78.3, no problems at all. But just come to the second situation. 100, 120, value determined by the valuation officer 110. What should be the consideration now? 110. Now let's go to the section. Right now I am given a safe harbor of 10%, right? Now if the stamp duty value does not exceed 110% the consideration received, such consideration shall be deemed to be the full value of consideration. I say that the stamp duty value in this particular case does not represent the market value. I go to the valuation officer, he determines the value as 110. Now, so in this particular case, should the 10% still be applied or not? That should have been applied, no, logically. There can be a variation. See, the basic point is that there can be a 10% variation. You cannot precisely sell at that value. That is the point. So therefore, what they could have easily done here, this DVO value should replace stamp duty value. If it is less, could have been a very simple wordings. If that happens, subsection 1 itself can take care of itself. Now what happens here? So here 100, 120, 110. So now your answer of 110 comes under which part of the section? No, you come to subsection 2, right? Now in subsection 2, without prejudice to the provisions of subsection 1, right? So that means, what does it mean? Whatever you are trying to write in subsection 2 should not affect the basic spirit of subsection 1, right? So here, the stamp duty value is 120, 110 is the valuation of the value. So that value again should not affect. Read the first starting words. Without prejudice to the provisions of subsection 1. What does it mean? So it should not affect the spirit of subsection 1. Now, if you imply the subsection 2 valuation of 110 on subsection 1, still it's within the threshold limit of 10%. And therefore, no, that's what I'm saying. Now, here, what we have to understand in this whole point is that is not the intent in the first line, right? So basically, what is the first one? If stamp duty value exceeds actual consideration, take stamp duty value, right? Simple. Now let's take this one. Now go to the third one. Now let's take the third situation. Now, stamp duty value is 1. I will just slightly counter what you say with the third situation. Now, let's assume for a moment I don't go into the valuation officer. There is no need also in situation 3. 100 is the actual consideration, 110. It falls within the 10%. So therefore, my consideration is 100. Now, what will happen if I have gone to the department valuation officer? He will arrive at the value as 105. No, forget about need. I am not talking about the need. I am talking about what is subsection 2 is trying to infer. Just for a moment I have gone there, and if it determines the value as 105, then according to you, the consideration is 105. So now my stamp duty value, when it is reduced by the department valuation officer, then you are saying in that particular case capital gains have to be completed 105. So that's why in 72, even in 50C, they are just trying to put it, the replacement of the department value does not and should not affect the spirit of the subsection 1. That's why we start with without prejudice to subsection 1. Whether I need or no need, forget for a minute. The point is that the 10% safe harbor is allowed. So if 110 is the stamp value, for which the answer is 100, right? Now when it is reduced to 105, you see the answer is 105. I have to pay capital gains on 105. Read with subsection 2 opening line, right? Without prejudice to the provisions of subsection 1. What is subsection 1? Read with the second paragraph, because they don't call it as a proviso. If you read it together, essentially the spirit of it is 10% cap is allowed. That's what is also been incorporated in subsection 2 also. So that's what they should have simplified the law by saying that the department valuation officer value will replace the stamp duty value provided it is less than stamp duty value. That's all. You don't have to say anything. You could have made it very simple. Whenever a reference is made to the valuation officer and the department valuation officer value is less, substitute that for stamp duty value. That's all. Simple. That I will suggest a simplification. 60,000 hours are not required. And now go to the third point again. Now go to the third one. You don't worry about whether I should refer or not. Right now. So if you go to the fourth situation, no problems. 90 is 105. You are going to take it as 90. Now going to the second situation now. 100, 120, 110. So my friend disagrees with me, but I still feel that it should have the effect of substitution. Now go to situation 3. If the value determined by the valuation of a reference made in subsection 2 exceeds the stamp duty value, such stamp duty value shall be deemed to be the consideration, is what they are saying. Now, go to the last situation. 100, 90, 105. So for your equation, what is the consideration now? 100. Now, go to this subsection 3. No. Now you go to subsection 3. We are trying to simplify the law. See, just give me 1 second. Now, I will give this provision in my class also on a very simple basis. Step 1, step 2, step 3. Simple. Take the DVO value or stamp valuation, whichever is less. Step 2, step 1 or actual consideration, whichever is more. Easy. But we are not talking about that, right? We are not talking about what is the law. What we are talking about is that what is that they have done which could result in more litigation. Take the last point. If the value determined the valuation of a reference made in subsection 2 exceeds the stamp duty value, right? Go to situation 4. What is the value determined valuation of there? 105, correct? No doubt. See, don't think logically and all. We are not talking about the logic. The simplification is what we are talking about. Now, in the last situation, subsection 3 applicable or not? If the value determined by the valuation officer on a reference made in a subsection 2 exceeds the stamp duty value, such stamp duty value is written as a full value of consideration. We'll come to the last part of the section first. First, get to the first line. Value determined valuation on a reference made in a subsection 2 exceeds the stamp duty. Yes or no? Yes or no? Yes, right? 105 exceeds. Then what subsection 3 says? Stamp duty shall be your full value of consideration. What it should say? No, let's not think logically here. I'm only trying to find out how the section has missed the trick. Instead of saying the stamp duty value shall be replaced with department valuation only if it is less. That's all over. Then it automatically gets figured out in subsection 1, right? Whenever you make a reference to valuation officer, if the value determined the valuation officer is less, then that shall be substituted for the stamp duty value in subsection 1. Will make the law simple, easy, this thing. But wait, I am not saying anything. See, please for a moment, this is not my wordings. I've simply extracted, copied and pasted from the Income Tax Act as passed by both houses of Parliament as signed by the President. If the value determined the valuation of the reference made in subsection 2 exceeds the stamp duty value, such stamp duty value shall be consideration. What they are trying to presuppose here is that in situation 4, people will not make a reference to valuation officer. Therefore, the answer is 100 is the presumption. Please read. I don't. See, you are very, very selective. When it comes to a question of 2, you are taking one stand. In 3, you take a different stand. Sir, what you are talking about is logic. I am talking about law. Law and logic need not actually be good friends, right? I am not, no. I also fully agree with you. That is why I take all my friends sitting here. That's how they also learned income tax from me. We are not talking about that. We are not talking about how the law should be logically read. What I am saying is that in the simplified language, how that gets read. That's what I am saying. I am not saying your view is incorrect. I already told you how I take step 1, stamp duty or DVO, whichever is less. Step 2, step 1 or actual consideration, whichever is higher. That's all. This is simple. These are the 2 steps. I fully agree with your answer, but I'm not talking about what is the answer here. I'm saying how the law was drafted which unfortunately, instead of trying to simplify, it complicates it. That's what I'm trying to say. They could have made it very simple when you are taking that much amount of efforts. Because so any discussion on capital gains will be incomplete without our 54 series. So I will take only 3 sections or 4 sections maximum time permits. Of course, without big distance, of course, the popular is section 54 and 54F. So I have not gone into the existing section because I think we have already had enough comparison between the two. We'll stick on to section 82. So where an individual or Hindu undivided family, as long-term capital gains arising from transfer of a capital asset, being buildings or lands a burden thereto, and being a residential house, the income of which is chargeable under the income from house property, and is within 1 year before or 2 years after the date of such transfer purchased, or as within a period of 3 years after the date constructed, one residential house in India, the new asset, then instead of capital gains being charged to income tax as income of the tax year in which the transfer took place, it shall be dealt with as follows. If the capital gains exceeds the cost of the new asset, such excess shall be charged under section 45. And for computing capital gains arising from the transfer of new asset within 3 years of its purchase or construction, the cost shall be 0. And the cost shall be reduced, same thing, except if the amount is more, the cost shall be reduced by the amount of the capital gains. Now, from assessment year 1819, you see every recommendation of the Institute of Chartered Accountants of India, every recommendation. If you're not seen, you can just go and see. Now, why this should be 3 years, this lock-in period? Why that lock-in period has to be 3 years? Now, here the section says, basically what they're saying, the new asset, you should hold on for a period of 3 years. That's what they're trying to say. So, if you transfer the asset within a period of 3 years, essentially what they are trying to say, your capital gains exemption given should be withdrawn. Instead of saying that, what they are trying to say, the cost of acquisition shall be taken as 0 if you have claimed full exemption. If your exemption cost matches, take it as 0. If you have an excess cost, that is you have invested 15 lakhs, but you claimed exemption of only 10 lakhs, you can take 5 lakhs as a cost. That's what they're trying to say. Now, why the 3 years is basically because 3 years is a time required for a land or building to become long-term till assessment year 2017-18. In assessment year 1819 itself, you have reduced the time limit for land or building to become long-term from 3 years to 2 years. Every budget recommendations of the CA Institute right from that year were saying that there is a need to change this 3 to 2. This is not one time. Every recommendation, which is very good, sensible, logical, absolutely beautiful recommendation. First point. Second point, now your idea is to simplify, right? Now 54 is available for long term or short term. Only for long term, right? It is available only for long term, beginning as long term capital gains arising on transfer of a capital asset. Now, what is the effect of this if you sell within 2 years? Because if you're going to sell after 3 years, there is a problem. Because if you sell between second and third year, the issue becomes slightly different now. If you sell within the first 2 years, the exemption is given only for long term. And if you sell within the period of 2 years, what happens is, though the exemption is given for a long term capital gains, the capital gains now becomes short term. So that is why we want this also to be 2 years. So now you are converting a long term capital gains into a short term capital gains. Now, is this provision consistent with all the sections? The answer is no. In 54EZ and 54F, the violation is treated as a long-term capital gains. In rest of the section, it is treated as a short-term capital gains. Now, when you are just trying to simplify and align, you have only 2 choices. Take for every section, the capital gains is short-term. Take for every section the capital gains is long term. Whenever the exemption is given, only for long term. Now you have a concept of simple, consistent, right? So therefore, what you can do is every exemption section of 54, you should say the same line of provisions. Or every section you come back and say if the capital gains exemption is taken for long term, it will be withdrawn only as long term. Now you give for long term and you withdraw as a short term, and the whole concept of why this was introduced not understood, and you continue to have that. Now I'll just put a slightly interesting question. What will happen if you sell between the second and third year? I'll give a numerical example. Your capital gains is 50 lakhs. You have claimed exemption of 50 lakhs by purchasing a new house. The new house you sell between the second and third year for 55 lakhs. Have you violated or not? Right? What is your cost now? 0. Because you purchased for 50, you have claimed exemption also 50. The cost becomes 0. 55 minus 50, if it's 0, what is the nature of capital gains if it is sold between second and third year? Short term or long term? Long term. 55 lakhs is a long term capital gains, right? You buy another house for 55 lakhs. Will you get exemption or not? Because the section, please read that, the section never uses the word exemption is withdrawn. The section only says if you sell within a period of 3 years, the cost will be taken as 0. Just for the sake of benefit, for some of you missed this example, my long-term capital gains on sale of residential house is 50 lakhs. I buy a house for 50 lakhs. My long-term capital gains in the first year becomes 0. Between the second and third year, I sell this new asset for 55 lakhs. Did I sell the property within 3 years? Yes. So what is the section says? If you sell within 3 years after claiming full exemption for your cost, the cost will be taken as 0. That means when I sell between the second and third year, in that year, my long-term capital gains is going to be 55 lakhs because sale is 55, cost is 0, capital gains is 55 lakhs. Is it a long-term capital gains? Yes. Is it on account of sale of residential house? Yes. Can I reinvest? Yes. If I buy for 55 lakhs, the entire capital gains is exempt from tax. That means now I get a more rollover benefit now. I can just keep on rolling over if I want. Is that what you wanted? That is not your intention, right? By making this as a short-term capital, you don't want to claim exemption again because short-term capital gains is not eligible for 54. But however, inadvertently from second and third year, you are trying to give you your original capital gains exemption. You can just keep postponing if you start selling between second and third year. Which possibly could have been addressed under the new income tax act. I'm not saying just forget the old. But in the new income tax, when you're drafting something new, you could have easily provided for the same. For example, if so one residential house in India, even today, I just find so many community houses are here. So especially when I enter into a joint development agreement, I get 3 or 4 flats. Will all the 4 flats eligible for exemption or not? So of course, people from this part of the state, so you are the first one to crack this judgment, which required an amendment in assessment of 1516 by Mr. Arun Jait, K.G. Rukmani Amma, Anand Baswappa, where the language earlier in the section was a residential house, a singular. Where the Karnataka court started, many courts in India followed. So you are the one who started that. The A singular appearing in that particular section should not be restricted to one. So it can be claimed for any number of houses. But there are so many judgments were trying to say, even if you take the case of Delhi High Court, even today it was approved that particular judgment, where the Delhi High Court made an interesting observation. It can be even in different blocks. I can buy one house in block A, the second house in block F. Still I should get exemption for both the houses, where the High Court made a beautiful observation. Today you cannot come back and say, See, for the sake of privacy, see, we are all seeing, that's why day after tomorrow, so like when there is a family wedding, the bride and the groom wanted the marriage to be held in their style. Had I told this to my father, I know by this time, even at the age of 28, I would have got a slipper in my face. Today they say this is how we wanted. You think we planned, okay, you watch. So only job for you is to finance it. That's all. Beyond that, what is that you have? It is, they use a beautiful word. That is our marriage. We all were thinking, see, I'm not taking right or wrong about it, because I'm just saying that how the world has changed. And this you have to relate it with the judgment of the Delhi High Court. So today, we all were thinking that it is a marriage of the family, and therefore in those circumstances, everybody should be collectively say how they dance, who will dance, all the stuff. They come back and say, what is your age? You are 50 plus, get out. You don't dance and all. If you want, you just come back, sit in the back and clap. So it is a very interesting one. But at the end of the day, so all of us from Chennai have come together, and still, though they want a space, still they are very much attached to the family and all the stuff. That's definitely we have to give the credit. That's what Delhi Court said. Today it is not necessary all of you should stay in the same house. You can stay in one block, another block. So therefore, we have a very interesting concept. Separately live together. There is no necessity for you to live together and separate. If that is the concept today, people should be allowed to buy one for them, one for the family. Just assume this was recognized by Mr. Piyush Goyal when he was the finance minister for a brief period of time, where even in 54, he allowed 2 houses. Even in 23-2, he allowed 2 properties for self-occupation. The reason from him was, today we have to recognize, they want to take care of the parents. Children also want the space, parents also want the space. Don't choke everyone. Give them the space with freedom. At the same time, they also want to take care. So we have to encourage that. That's what Delhi Court said. So why they should live in the same house? They can live in different house. Exemption should be given for it. It will also be considered as only one house. So many decisions we can show even after assessment of 15-16, that if you buy more than one house, unless it is in 2 different cities, you can claim exemption. So again, there was no effort was made to change this particular point. Now, if you go to the beginning of the section, being a residential house, the income of which is chargeable tax and the income from house property. Now, my friend will definitely disagree with me, so therefore I'll go with him because I want some disagreement. So he buys one house for the sake of section 54, residential house he purchased. That house he uses for his own profession. His wife says, no, I can't stay in that place. You go and keep your office. So I'm satisfied in the existing house. So therefore, having purchased the property on February 14th for the sake of his wife, he is suddenly disturbed. Okay, fine, at least you'll for my office. Will you get exemption to 54? It's a residential house only, but you're using for office purposes. Will you get exemption to 54? Is that the intention? The answer is definitely no, because the intention is to buy a residential house. But if you look at the beginning of the section, which is original asset, they say the income should be chargeable to tax and income from house property. But whereas in the invested asset, new asset, he says after that date constructed one residential house in India, that residential house need not have to be taxable and income from house property, not required at all. So therefore, you bought a residential house, you are not staying, but you are using your office. The income is not taxable under section 22 because section 22 makes it very clear. The property is used for own business or profession, it's outside the charging section. So income is not going to be taxed under HP at all. It's not annually 0. It's not taxable. Will you still get the exemption? No. Is that spirit of the section? Answer is no. So what I would have drafted this, one residential house in India, the income of which is chargeable tax and income from house property. Because that is not the intent. I want to simplify, at the same time, I also want to make it the law simple. Intention has to be very, very clear. Even in one residential house, I would have said one residential house for this purpose mean one residential house, whether it is in the same flat or apartment or same block, anywhere, only one house means one house or a unit of house. Beyond that, you will not get exemption at all. So those are the things which could have easily worked on it. Now comes the next point on the deposit scheme. Now section 54(2) used to deal with the capital gains deposit scheme. Same as here, which is going to be slightly differently numbered as such, 82(2), 3 and 4. That split 54(2) into 3 subsections. If the capital gains referred to in subsection 1 is not used by the assessee to purchase a new asset within 1 year before the date of transfer of the original asset, or is not utilized for purchase or considered new asset before filing the return of income under section 263. 263 is corresponding to 139. Only problem for us, 263 means we will only talk about commissioner powers to Somoto. Suddenly, even to get into the grips of it, it took some time for me, because 263 is something, is hit on our head. 263, so here 263 is nothing but 139. Now, then the unutilized amount shall be deposited in a specified bank or institution and utilized as per the scheme notified by the central government. Such deposit shall be made before filing the return of income and not later than the due date in the case of assessee for filing the return of income under section 263(1). Now go to the fourth line, filing the return of income under section 263, 139. And when you go to the later part of the section, the deposit under 130 for the purpose of capital gains account scheme cannot be made beyond the time limit specified in section 263, subsection 1. One of the reasons why I was, in fact, I can always remember the late T.N. Manogaran whenever I discuss this particular point. That was my second program. I was very happy to see him sitting in the last bench in observation. Now, this was the issue, because I thought when I get an opportunity to speak, I should speak something which has not been decided, which has not been settled, which is also thought-provoking. That was my idea. I was very clear what should I talk. Now here, of course, those days, belated return, revised return and all, you can file even after 2 years. Now today, you have to file your belated everything by 31st of December. Look at the surprising part of, you have a due date of 10th December. Within 20 days, you have to revise as well as file a belated return. And they're too smart. Whatever benefit you had earlier by way of belated return up to 2 years, that they made it as an updated return. Only difference, you have to pay tax, interest, and also 25% or 50% or so on and so forth. So by reducing your time limit for belated and revised return and converting that into 139.80, the government was already giving you the powers you already had and then charging an extra amount. I think that's one of the, and at some point of time, I'm sure at some point, I don't have a defined term. One thing you can be sure, the amount at some point of time collected by way of interest, fees, penalty, surely at one point of time will exceed the tax. So I think that seems to be a very, very interesting idea. Now here, so look at this. What if by 31st of July, I could not purchase or construct? I don't know there is a capital gains account scheme. I did not purchase. As usual, the client comes on the last day. Oh, sir, did you purchase? No. Did you deposit? Sir, deposit? What deposit? No, otherwise you have to pay tax. No, sir, do something. Sir, what can I do? I can't do anything. But you just read the section if somebody is willing to take that particular point. So, beginning fourth line, purchase or construct new asset before filing the return of income under 263. 130, no subsection is there. Let's assume you hold this return. Ask him to purchase the house before 31st December. He purchased the house for the full capital gains. Whether he should come to the account scheme or not? The answer is no, because when the deposit scheme will apply, when I have not used it for purchase or construction before filing return of income under 263, which is correspond to 139. I purchased house before 31st December, before filing my tax returns, right? So return filed under 139.4 or 5, also under 139 only. No, it's not a different section. Did I purchase? Answer yes. Therefore, I don't want to read the rest of the section. But what if I want a deposit? The section says the deposit, if you want to choose, it has to be made before 263 subsection 1. So therefore I said, in that particular forum, if you could not deposit, hold the return, purchase, then file the return, there you had extra time and all. So in that particular case, deposit scheme will not apply. But if you choose to deposit, it should be done before 139.1 or 261 as the case may be. So every senior member is present for saying that, say, look, your argument looks right, but you should not read this since you are a youngster. At that point of time, you are a youngster. So he told like, look, you are a youngster, your interpretation good, but you have to read a harmonious construction. The 263, the fourth line, should be read along with section 263.1, and therefore the purchase deposit all should be made before the time. That's what various seniors were saying. Suddenly, Mr. Manokaran stopped. He said, I think he has got a point. I think it's definitely from the section, it appears it is possible. From here onwards, for this discussion alone, we should not call him as TGS, we should call him as CGS. So this was the name given by him. That was my proud moment when I saw his body. And I was saying, thank you very much for this wonderful words. I can still not forget it. But now the interesting twist. After that, many decisions have come which says you can deposit even after 139 due date. Because they said this has to be read with that. So therefore, there are many decisions which allows deposit scheme to be also made after 139 due date. You can even deposit before 263, this corresponding 139. When I read that judgment, I was remembering those days. So I was saying, you can purchase up to 139.4 or 5, but deposit 139.1. Members said, no, both 139.1. But the courts have said, no, both can be 139.4 or 5. So that's a very interesting point. Again, if you look at this particular point, what is the problem in putting one subsection 1 there at the beginning, no? In the fourth line, you could have put 263.1. It just needs adding one subsection number there. So, okay, fine, that is not your mandate, I can understand. But these two synchronization only, no, it is not a different point. So when you read, in many places you have tried to make a synchronization. This is only synchronization. You can always tell the finance ministry, we have not done anything new. We are only synchronizing, that's all. So, but still, the problem continues. Now come to the next point. For the purpose of subsection, the amount already utilized for purchasing together with the amount deposit shall be subject to subsection. If the amount deposit subsection 2 is not fully utilized for purchasing within the period specified, the unutilized amount shall be charged under section 67 as the income of the tax year in which the period of 3 years from the date of transfer of original asset expires. Now here, so this is also the continuation of the existing point. Let's take one small case where somebody made a deposit. And he went to the bank. See, one thing which I found, most of the bank branches are not aware of something called capital gains account scheme. So this is something very, very common in Chennai. I don't know about Bangalore. Maybe they may be more familiar. So you have to tell them what is this account scheme. So just the context you understand. So somebody has put in the capital gains account scheme. Suddenly his son has to go outside India. He requested the bank manager, this has happened, therefore I don't want to withdraw. Though as per the Income Tax Act rules, capital gains account scheme, this cannot be done. See, on a compassionate ground, for some reason the manager accepted and given it. Now, let's not get into, I don't know what problem he went into. Let's leave it. We'll see the assessee's problem. Now, when is this capital gains account scheme taxable? Now, there is a violation. No, I deposited 50 lakhs and came to exemption. The very next year, I withdrew not for the purpose of purchasing the house. Obviously, the exemption is given only for you to purchase a house. But the section says, even if you violate, you have to wait for a period of 3 years to pay the tax. And that continues today. So what I'm saying that you forget about what they should do as per the law. What if they somehow for ignorance of law they do it? Should the law wait for taxing it for a period of 3 years? So if you make a violation, let's say take a simple case, I should purchase house within 2 years only, no. So I have a deposit of 50 lakhs. I purchased for 49 lakhs. Remaining amount I not purchased. Now, what is the position of law? The capital gains account scheme says, to close this account, you have to go to the income tax officer and get the certificate from him. And what will he say? Let's assume 50 lakhs are purchased for 30 lakhs, remaining 20 lakhs have not used. You say you pay the tax. But what should I tell him? That 50 lakhs I deposited, I claimed exemption. I purchased for 30 lakhs. I now want to close the account. He says you pay the tax and close it, then only I will give the permission. But is that what the law? The law says I have to pay tax only after 3 years. So how can the income tax officer ask me to pay the tax for that year in which tax itself is not due to me? Take a simple case. I have only 2 years to buy an existing house. I purchased for 30 lakhs and say that that's all. I'm not intending to purchase anymore. I can't even buy more than one house also, right? So remaining 20 lakhs, when it is taxable? Only the next year. So the only way is that you keep a small balance of 100 rupees, then the odd withdraw type of situations are there. So therefore, these are the very, very small points. These are all not very sweeping changes. These are all some practical changes which you could have done in this particular section. Now, so again, the great opportunity which has missed out. I'm not saying make a sweeping changes, but you make some simple changes which will make the life comfortable for anybody. Now, which is there in, now this is there in Proviso 1 and 54.1. They've just made it a separate section. So, so one on the 10 crores and also the 2 residentials which you can purchase, Mr. So Piyush Goyalji. So considering the present situation there, but so what is very interesting point here is that the capital gains in this particular case, 2 residential houses, provided the capital gains does not exceed 2 crores, right? Now, when you remove the indexation of cost of acquisition, so what happens as a result of this? What we found in many cases this time, the assessee loses the benefit of even choosing this 2 crores. So ideally, when they said that it is for the purpose of tax rate, maybe they could have tried even for the purposes of exemptions also, which is not the case. But anyhow, so this is something we can't expect them to do it for the purposes of this. Again, the 10 crores, they made it as a separate section by itself under 54. It was part of Proviso 3 to section 54.1. So that's there as section 82, 7 or 8. So just for the sake of understanding how the sequence, 54 has become 82. Written filing reference 139.12631. The 2 house option of Proviso 2 and 3 has become subsection 5 and 6. 10 crore limit of Proviso 4 has become 7 and 8. So 45 has become 6 and 7. So it doesn't need any, even the remembering of sections. Once you understand the pattern on which they have done it, I'm sure it's pretty easy to remember the sections also. Not difficult except for adjustment of the reading of section numbers. I don't think much has really changed there. Now take 54B. This is another very interesting point. As capital gains arising from a transfer of a capital asset being a land which was used by the assessee or his parent or the Hindu family for agricultural purposes, original asset, the 2 years immediately preceding the date of transfer, and as within 2 years after that date purchase any other land when used for agricultural purposes. Now, if you see at the beginning of the section, that is in the original asset, capital gains arising from a transfer of a capital asset being land which is used by the assessee or his parents. Now, the answer, the very easy interpretation for A of 83.1, you don't get any capital gains on transfer of rural agriculture land. So, rural agriculture land is not a capital asset. The question of getting capital gains does not arise. So, come to the second point, as within a period of 2 years after that date, purchase any other land for being used for agricultural purposes, then instead of capital gains being charged to income tax. Now here, the word capital asset is missing even under the new income tax act. So that means the new asset can be in urban area also. That means you can even have agricultural land in urban area or in rural area. Both are eligible for exemption. There is no exclusion here. Both rural agricultural land and urban agricultural land both qualify for exemption under 54B. What after purchasing a rural agricultural land, claiming exemption to 54B, I sell that asset? Because like any other section, this section has also got a lock-in period, right? What is the lock-in period? Again, it should have been only 2 years, but it continues to be 3 years. I have a 3 years lock-in period. I sell within 1 month after claiming exemption to 54B. But I have purchased only rural agricultural land. So what will happen now? The section like 54 says, if the capital gains exceed the cost of the new asset, such excess shall be charged under section 67, and for computing any capital gains arising from the transfer of new asset within 3 years of its purchase, cost shall be 0. I'll just give a numerical example. I have a capital gains of 1 crore on sale of urban agricultural land. I purchase another agricultural land in rural area for 1 crore. Is my capital gain 0 now? Yes. After some 1 month or so, I sell this agricultural land. Am I violating? Yes. What is the consequence of the violation? The consequence of the violation is that the cost of the new agricultural land will be taken as 0. Let them take it as 0. I don't have a problem, because the rural agricultural land is not a capital asset. Therefore, whether they take the cost as 0 or 5 or 10, doesn't matter for me. It's not going to be taxable. Is it a loophole? Yes. Have they plugged it? The answer is no. It just, the simple point is that instead of using this language, they could have simply said whatever exemption you have taken under 54 or 54B or all the sections will be withdrawn, like what you are having in 54EC or 54F, as a short-term or long-term capital gains, as the case may, based on your original asset in the year in which you do the violation. This is what simple. You don't need anything. All the sections, you can have one section to say that the conditions of those sections are violated. The exemption will be done as a short-term or long-term capital gains based on your capital gains on the original asset. But here, there is a language change, but that does not alter the position of the law. Except you have to remember a new section number. Instead of 54B, you should know that is 83. Otherwise, everything remains the same. So take 54 EC, but I've tried maximum on this 54 EC. Why the limit has to be restricted to 50 lakhs? I don't even understand at all. So here, you are allowing the investment done in REC or NHI or most important infrastructures alone. IRIDAs, all of them are only into infrastructure. The government has consistently maintained we need around 50 lakhs crores for infrastructure. All these bonds give you only 5% only. And if I am honestly, I'll tell you, I will never invest personally in REC bonds. I consider it's financially not prudent for me to go at all. It's absolutely, if I had to apply my learning, I have been a financial management teacher for almost 15 years. I consistently shown the investment in REC bonds is only for ultra conservative. Those are, I don't want to pay tax. That's itself satisfies me. Fantastic. If you really want to take it as an investment decision or financing decision, I'm sorry, that's not the greatest of decisions at all. You can instead, you can pay 12.5% tax, invest somewhere else, your final return will be more. But however, in India, If you say you have to do something to save tax, people are ready to do it. That is the only reason why these REC bonds are successful. And then why you want to restrict, I don't know. Of course, I know. The reason is, this one gentleman in Chennai invested 150 crores in 50 REC bonds to claim exemption when he sold a very prime property in Anna Nagar. It came in all the newspapers, there was an investment. Immediately through a circular, they want to restrict it because REC, NHA and all have a cap on how much they can raise under 54 EC bonds. First of all, this cap itself, the government should rethink whether they should do it. Now, therefore, they brought a cap of 50 lakhs through a circular. Again, how can you do through a circular? Therefore, they made it as a law subsequently. But what they said was, your investment should be 50 lakhs in any financial year. Suppose if I sell in the second half, say let's assume I sell on 1st January 2025, my 6 months gets spread into 2 different financial years. So therefore, I can invest up to March 50 lakhs, and then between April to June another 50 lakhs, I can claim exemption up to 1 crore. See, first of all, the thinking itself has to change. If somebody is willing to do 1 crore, take it in both the hands, give him some email. Thank you very much for contributing to the nation's welfare, apart from saving your tax. Because, very honestly, please go and make any mathematics number. Investing in REC bonds is not financially a great decision, given the alternative investment opportunities available today. But therefore, what they did was, they made an amendment in the section that in the year of transfer and in the subsequent financial year, your investment should not exceed 50 lakhs. With a very interesting point, certain people are misusing. I don't know, they are using, not misusing. Let's, for example, if you take up to 28th September, if you leave out of India for employment purposes, you are a non-resident. If you leave on 30th September, you become R&O. Let's assume you go to Middle East, where there is no personal tax. Somebody leaving on 28th of September will pay 0 tax. But somebody leaving on 30th September, unfortunately, has to pay tax. You cannot come back and say a person leaving on 25th of September has misused the section. No, he has used only, no. Same year, you say 50 lakhs in the financial year, 6 months' time, somebody is lucky enough to sell in the second half, therefore he is using it. And he is also contributing. But now you just come back and make a change that continues in this year also. You can see 54 EC2. For the purpose of subsection 1, investment made in the long-term specific asset from capital gains arising from transfer of one or more original assets shall not exceed 50 lakh rupees during tax year or in the year of transfer of the original asset or assets and in the subsequent year. 2 points which you need to appreciate here. One, arising from transfer of one or more original asset. That means they're trying to make it very clear that suppose if I sell land and 2 lands, I can't use 50 lakhs for one land, 50 lakhs for another land. Like one is land, other one is building. I can use 50 lakhs for land, 50 lakhs for building. So that's what they're trying to say, one or more asset. Now, first year, I sell 1 land. Second year, I sell 1 land. Now, look at what is the provision. It says during the tax year or in the year of the transfer of original asset or assets and in the subsequent year. Financial year 24-25, 50 lakhs. I sell a land. 25-26 also I sell a land. I purchase another 50 lakhs. Now what will happen now? Now 24-25 I sold 1 land. My capital gains is 50 lakhs. I purchase REC bonds 50 lakhs. 25-26 I sell 1 more land for same capital gains of 50 lakhs. I buy for another 50 lakhs out of the second asset coming in the next year. Now, what will happen to my first year capital gains? Will I get exemption or not? You go by the section or go by the spirit? So now, sometimes you go by the section, sometimes you go by the spirit. You go by the... Yes, one Tamil comedy is there. I don't know how many of you have seen some Tamilians, but இதை வச்சுட்டு காமெடி பண்ணி அப்படின்னு ஒரு ஜோக் இருக்கும். So likewise, so if you read the section on a plain basis, during the tax year and in the year of transfer, original asset. So therefore, what will happen? The second year capital gains are buying 50 lakhs. First year capital gains are buying 50 lakhs. But unfortunately, what will happen? In the year of the first year plus the second year, 50 plus 50, 1 crore. My friends in the department can come back and say, sorry boss, you have violated 54 easy. Which is not intended at all. You don't say 50 lakhs your lifetime exemption, or you can't say 50 lakhs as an exemption of 2 years put together, right? It should be transaction wise of that particular year, could be the most ideal point, as my friend was saying. This time I agree with him. So, but just the existing 54EC you have not touched. See, you should not see 54EC bonds is something you are giving as a concession. Instead, you should see the government, which needs 50 lakh crores, needs this kind of a support. It's a win-win. It's not that you are just trying to say we are willing to come back and give PLA schemes and so many schemes for the purpose. This is like a PLA scheme only, where you are incentivizing the assessees for contributing to infrastructure. In the process, they say 12.5%. Today, it's not even 20%, only 12.5%. So I think there must be a change in the thinking. That thinking, when you move to the Income Tax Act 1961 to 2025, you're going to come back and say, I think your 50 lakhs limit doesn't look logical. Let's take it out. You say, let them claim any amount of exemption because you give 5. Even I suggested, don't keep the lock-in period as 3 years. Keep it as 5 years or even 7 years. If somebody doesn't want to pay tax, they don't mind. Especially, I have one gentleman who's 75 years old. I said, no sir, REC bond, I'm comfortable. After 5 years, is tax free? No, yes sir, tax free. No sir, I will put. So how much I can put? Sir, can I put entire 5 crores? No sir, you can put only 50 lakhs. Why sir? I don't know sir. Now, I'll skip this part of it, just come to the relevant portions of it. See, I've just written the corresponding provisions here. 86.5 to 86.7 is, you should read with 54F1 proviso. Now read subsection 5 and 6. So, owns more than one residential house other than new asset, purchases any residential house other than new asset within 1 year from the terms of original asset, constructs any residential house other than new asset within 3 years from the transfer of original asset, the income of which is chargeable tax under IHP. Say the assessee purchases within 2 years after the date of transfer the original asset, constructs within 3 years of such rate any residential house, the income of which is chargeable tax from the IHP, blah blah blah. They shall be chargeable tax as a long-term capital gains of the tax year in which such residential house is purchased or constructed. Just like it is the year of violation. Now, in 5A2 versus 6, do you find any contradiction there? Now in 5A, which is corresponding to 54F1 proviso, I just put 4 conditions. You should not own more than one new residential other than the new residential house. The second point, purchases any residential house other than new asset within 1 year, constructs within 3 years. Of course, the income should be taxable under IHP. But whereas you go to subsection 6, if the assessee purchases within 2 years after the date of transfer of original asset or constructs within a period of 3 years any residential house, the income from which is chargeable tax under IHP, then the amount exempt shall be withdrawn. Now, what do you find as the difference between subsection 5 and subsection 6? Now, subsection 5 says you cannot claim 54F1 if you satisfy that 1, 2, 3. If you have more than one house, if you purchase other than the new house within 1 year, you construct any residential house within a period of 3 years other than the new residential house for a period of 3 years. Whereas 6 talks about what if you do that, right? 5 talks about the conditions. If you have 2 houses on the date of transfer, you will not get the exemption at all, there is no problem. Let's take the last one. If you construct second house within a period of 3 years. So you don't get 54F exemption, but you would have already filed the tax return, you would have claimed the exemption, right? So what will I do if I construct the second house after claiming exemption that year? Because either you should have constructed or you should have deposited, right? In any case, exemption happens in the first year, either through deposit or by constructing the house. After that, you construct one more house. Now what should I do? Subsection 5 says exemption is not available. But how should I do that? Do I have to go back to the return and rectify under 154 or reopen under 147, or what should I do? Or is subsection 6 is a consequence of violating the conditions of subsection 5? What is your reading? Is subsection 6 consequence of you violating subsection 5 or not? Yes. So therefore, subsection 6 is basically handles a situation where you violate the condition after claiming the exemption. Now, if you see the clause 2 there, subsection 5A2, purchases any residential house other than new asset within 1 year. But go to subsection 6. Is it 1 year or 2 years there? 2 years. So, in subsection 5, it is 1 year. But in the consequence section, it talks about 2 years. This has basically happened on account of a drafting error. Originally, for a lot of young faces here, those who are not used to this 54F, originally section was allowing 1 year for purchase, 2 years for construction. Subsequently, the section was changed. Purchase they allowed 2 years, construction they allowed 3 years. Both in 54 and 54F. Original time limit is 1 year for purchase, 2 years for construction. Revised time limit was 2 years for purchase and 3 years for construction. So what they have done in 54F1 proviso, unfortunately, even as on this date, despite the extended time limit given for 2 years for purchase, the section even today continues to be only 1 year, which is a drafting error. They have not changed the law. But in the consequence section, they correctly made it as 2 years. Fine, okay, under the old law, you will not have time to see, right, understandable. This time you have spent 60,000 hours, no. See, at least that time you don't have the time, fully agree. When you are writing a new law, so many people are there, so many people are reading the section, so many corrections you have made. So, unfortunately, 54F1 versus 54F3, corresponding to 54F1 proviso puts a condition, 54F3 provides for violation. Now, that disconnect has been missed out there, and that continues in the new section also. 86 continues to say the same words. Now, that is something which is pretty interesting here. Ideally, hopefully, when they are trying to propose changes in this finance bill, let's hope that these changes are corrected. So take for example 8610. For the purpose of this section, net consideration means full value of consideration received or accruing as a result of the transfer of original asset as reduced by any expenditure incurred wholly and excluding connection with transfer. 54F1, net consideration related to transfer of capital asset means full value of consideration received or accruing as a result of transfer of the capital asset as reduced by any expenditure incurred wholly and excluding connection with such transfer. So I think my friend will become excited when I come to this section because I'm going to connect it with your other favorite section. But before that, is there any difference between 8610 and existing 54F? Is there any difference? No, you can say yes or no, not a problem. Is there any big difference? Absolutely no difference at all. So except for the fact 54F, it is there in the explanation. Our idea is there to remove all provision and explanation. Once you want to remove all provision and explanation, what you should do? You should introduce as a separate section. That's what they have done. Removed the explanation, introduced as the last subsection of section 86. Now, net consideration means the full value of consideration received or accruing as a result. Now, let us take again. I'm excited now because he's a champion of 50C. So, 100 lakhs is my actual consideration. A stamp value is 150 lakhs. Let's assume I don't dispute and all. So what is my full value of consideration for the purpose of 50C? No dispute, no valuation officer and all. So therefore, there's no need for us to look at the subsequent sections of section 78. 100 is my actual consideration, stamp duty value 150 lakhs. So what is my consideration for computing capital gains? For computing capital gains, 150. Now, so in 54F1 or 8610 defines what is net consideration. The net consideration means full value of consideration minus expenses. Now, if you go to 50C, the stamp valuation shall be deemed to be the full value of consideration, shall be deemed to be the full value of consideration. Now, recollect what we discussed in section 50, the decision of Supreme Court in Dempo, where the provisions of section 50 treating as a short-term capital gains is applicable only for the purposes of computation of capital gains. It shall not be extended to exemption. Principle. In 50C also, they will not say notwithstanding anything contained anywhere in the Act. It's not there. It only says for the purpose of section 48, corresponding to section 72A. So now the question here is that I have purchased a new residential house for 100 lakhs. What is my stamp valuation? 150. But I purchased only for 100 lakhs. Now if you read 54F or section 86 as the case may be, if you have invested the entire consideration, then the entire capital gains is not taxable. Now, how much I should invest? 100 or 150? Now, in 54F10 explanation or 8610, that section itself defines the meaning of net consideration for the purposes of exemption. We all know specific provision will always prevail over the general provision. 50C is general, whereas 54F is a specific. The specific provision says the net consideration means actual consideration minus expenses. So one issue which has been hanging on for quite some time, should 50C stamp valuation should be substituted for the purpose of 54F, whereas for the purpose of 54F, should I have to take the deemed consideration of 50C or only the actual consideration? Because there is a Bombay quotation which did not agree, but there are a lot of decisions that support that. Oh, leave that for a minute. Okay, let that fight go on before the Supreme Court, right? So in the new Income Tax Act, so what is the courts are saying? 50C does not make a reference to 54F. 50C is only talking about section 48. So, in order to reduce the litigation, what you should do? See, even I also don't agree with that particular point. You should substitute, you should take only the actual consideration. It's only a technical plea we are doing it. Now, what could have been done either in 78 or in this section? Net consideration means the full value of consideration. The full value of consideration should be taken here as if it's covered by 50C, the stamp valuation as the case may. So it is a very simple point. You have to, in this particular case, define that. But what we have done by choosing to continue the same words, what potentially could have saved hours of litigation, hours and hours of litigation, by just adding either in section 78 or in 54F that the full value of consideration means the consideration for the purpose of section 48, whether actuals or deemed consideration as the case may be, could have resolved this issue and would have not only made simple, but would have also reduced the litigation. So what has actually happened here? Except for this explanation moving to a separate section, the controversies continue to remain, or fight continues to remain. So people might come back and say, when you fight, pay the tax. But instead of expecting that, you could have made a very simple change that for the purposes of 50C corresponding section 78, you also take the deemed consideration. Whatever you take as a consideration for the purpose of section 48, 72 on the new act, should also be taken for the purpose of this section, would have virtually reduced the litigation. So, before I just conclude, we can just keep on talking about, just take one small example here. Now 55(2)(a), most of you will be familiar. Cost of acquisition of intangible assets is 0 or purchase price, right? Purchase price or 0. For goodwill, is depreciation not allowed from 1st April 2020. Now, so what they are trying to do in the definition of cost of acquisition, the cost of improvement does not include deductions in the 4 sections. Then you go to the next one, the capital asset is goodwill of business operation, and the assessee has obtained deduction of depreciation 32(1). Then the cost of acting good will be actual purchase price if purchased from the previous order. Then you also reduce the depreciation and take that as a cost. Now, even if this point is not there, will section 50 applicable or not? Now, the answer is yes. Now, what's happening now? By bringing it as a part of section 55(2)(a) or corresponding to section 94 here, you are now trying to say goodwill of a business profession will be taken on the basis of actual cost minus depreciation claimed. Right? That's now which section is going to apply? 50 or 55? Based on the old act. Which will apply now? You are defining specifically for the cost of acquisition of purchased goodwill as purchase price minus depreciation claimed up to 31st March 2020. Section 50 also says if you have claimed depreciation, you have to take the cost of acquisition as WDV. But here you are specifically saying for goodwill, the cost of acquisition will be purchase price minus depreciation. Which section do you think will prevail? 50 or this section? This section. Because this is the specific section. Now, in section 50, if the asset is sold, even after 24 months or 36 months or whatever period, is always going to be considered as short-term capital gains. But if you come under this section, and if your goodwill is sold after 3 years or 2 years, whatever be the holding period, let's assume the holding period becomes long-term, this will become long-term capital gains. Now, with attractive tax rate of long-term capital gains at 12.5%, you removed indexation, brought it 12.5, but the 12.5 is applicable everywhere. Now, suddenly what happens, if you apply this particular section, instead of paying tax at a higher rate, you end up in paying only 12.5%. Take the case of a company. So, instead of paying tax at the rate of 26%, it will end up in paying only 12.5%. So what they could avoid, there's no need for this section because it's already taken care by section 50 of the Income Tax Act. There's no need to have this section at all, which you continue in the new Income Tax Act. So take the same case. So in the case of cost of improvement. So in the cost of improvement, they specify if you claim deduction under other heads of income, you cannot claim. Is it there for cost of acquisition? The answer is no. There was a very interesting decision by the Chennai bench of tribunal. Interest on capital borrowed for purchasing a house property, even if you are claimed under 24B, you can still claim in capital gains. That is why they would have made an amendment in section 48. Interest claimed under 24B or 80EEA cannot be claimed again, or 80EE cannot be claimed here. Now, so what will happen for any other deductions? Still, the Madras bench tribunal case, you can still think, ideally what I would have done. So here you already have the cost of improvement does not include any expenditure claimed under other 4 heads of income. What you could have done is, here result you could have made a change. For cost of acquisition or cost of improvement, you cannot claim whatever expenditure you have claimed under other 4 heads of income, you cannot claim, would mean there is no need for you to have a separate section, section 90. If you go to section 90, they will specifically say, interest on capital borrowed cannot be claimed under 24B or chapter 6A, cannot be claimed as a cost of acquisition. Do you need a separate section? The answer is no. You just need 92 has to be just changed. That would have eliminated 2 sections. That would have also simplified the law. That would have made applicable to all the sections. So the whole exercise seems to be more to rewrite the law in a more simple language. It's good, very structured, fantastic. But however, the changes to limit the controversies are not found. Again, many of my clients come back and say, no, I just don't want to really waste my time. Can I go to the income tax department, ask the tax implication this transaction, and I'll go with it. So essentially what they say is that, can I get an advance loading? I don't want to go into liquidation. So that advance loading mechanism can be introduced for all assessees with a particular threshold, with a very fast track mechanism that will reduce litigation, which is not found here. So again, of course, our institute has always been the property taxes challan of the client. So I just call the client, so why you sent the property tax challan to be paid by you to me? Is there my table? Oh, sorry sir, my accountant asked me there is a notice came for tax. Then I told him, send it to auditor's office. Then I told him, boss, it's property tax has nothing to do with income tax. That's the kind of synonymity we have. So I think we should be strongly involved. As I said, the direct tax committee prepared an extraordinary efforts in suggesting many things. Unfortunately, many of them not taken up, but we did a wonderful job there. Especially the direct tax committee team worked day and night to bring some excellent. What we have to only do is review that, but they've spent a lot of time and efforts. I don't want you to think that you are saying all those things. What did you do? Institute itself did some extraordinary things. They brought some beautiful, beautiful suggestions. And of course, fast tracking the appellate mechanism, of course, you will be aware of finally the National Tax Tribunal case, which is hanging on balance. So the National Tax Tribunal is supposed to replace the High Court. So one bone of contention was, can chartered accountants appear for the other side? Because currently, which has not been allowed in High Court. So that controversy has been recently removed by the Supreme Court. And therefore, it's just time to really set that mechanism so that the courts are not burdened with many of these cases. So if, of course, the beginning is made, we have to appreciate that. A lot of efforts they have taken. So only the 60,000 just to bring the lighter moments. Honestly, they have spent quite a lot of time. They have not been allowed to, they have to spend time away from the home. All my friends in the department have really given heart and soul. There's no doubt about it. They spend quite a lot of time. But their mandate, so as only to rewrite the law. That's what's they're studying. They've said, you don't do anything else. Just change. Any changes you want, we can make subsequently. First, bring the law in time. We have to do it, and that's why. So other things which I mentioned are just on the lighter side only, because otherwise, it's always a very tough to take an afternoon session. The most difficult. So I don't know, Manjunath, when he called me for the afternoon session, I don't know, he wanted to take a revenge for me taking classes for him or anything else on the lighter side. So therefore, those 60,000 hours on the lighter moments, all those things are just only for the lighter side of it to make the moments. I think they've also put in a lot of efforts. I think a combined effort of both ICA and the department will go a long way in just making this income tax truly the whole purpose. If it's simple. The idea is that M of mitigation litigation, eventually, even if I'm going to lose some cases, doesn't matter. I think the law has to be simple and litigation minimized. With those words, I'm just, thank you very much for your patient hearing. It's been fantastic, wonderful talking to you. So if you have any questions, maybe subject to availability of time and the chairman's permission, we can take up our questions. Otherwise, so I thank you very much. And of course, I must have thank my family also, because amidst all this close family function, they said, okay, no problem, you just go. It's more important. So I also take this opportunity to thank them. Thank you very much. Thanks for your patient ear.
Good evening, everyone. On behalf of managing committee members of Bangalore branch ICA and all members present here, I, C.H. Prakash, privileged to propose a vote of thanks for this truly insightful session. Thank you, sir. Your session on capital gains was truly mind-blowing. The way you simplified complex provisions and shared practical insights has been invaluable to all our members. We are profoundly grateful for you taking the time out of a busy schedule to deliver such a wonderful, engaging, and informative session. May I request our respected Chairman, Bangalore Branch, C.A. Manjunath Hemalo, to kindly come forward and present a small memento to CA T.G Suresh sir as a token of our sincere appreciation. Finally, I would like to extend my heartfelt thanks to all the participants for your active presence and engagement throughout the session. Your enthusiasm makes these events a success. Thank you all. We look forward to meet you again at our next CPE session, which is scheduled on next Wednesday, December 3rd, 2025. Thank you.